Welcome to the September 27th, 2019 video version of the Wagner Daily. My name is Rick Petticelli, and as usual, once a week, this video replaces the written commentary portion of our nightly report, and hopefully it offers some insight as to how we set up our charts, what indicators we use, what time frames, and also serves as a nice change of pace from our usual report. So let's get to the charts. First up is the S&P 500, which has held up best among the broader based averages. It's still above the 50 MA with the 20 above the 50. And there's clear support at the 294, 295 area with the 50 and the prior, with the 50-day moving average in blue and the prior highs here. But if it does lose the 294 support area, then a test of the 200-day MA is possible. But basically, a break of the 294 area puts this entire range back in play. In the Nasdaq composite, 2 of the past 3 days have closed below the 50-day moving average, with the price dipping below support from the 50 and the prior highs at 80, around 80.55. So the Nasdaq is right on the edge here. Another big down day, and this index could pull back into the 200-day MA. There's also this uptrend line that it's just holding on to here with several touches along the way. So a break of, I'd say, the 79.50 level could lead to a test of 77.50. Again, much like the S&P 500, puts the entire range in place, so we have just one big chop fest. IWM, just a big range here. It's in the middle of the range with the 250-day MAs right here. If support around 151 is unable to hold, then look for a test of the 145 area. And the last index here is the IBD 50 ETF, which represents 50 of the strongest growth stocks. And I just wanted to show everyone how it's underperformed the past 2 months after getting shellacked early August. It hasn't been back above the 50 EMA since. It's failed to reclaim the 50-day MA on multiple attempts, and now it's hovering around the 200-day moving average and is in danger of breaking that level. But again, it still has yet to do so, and all could be forgiven if it can break this downtrend line and get back above this 33.50 area and turn up. So just to recap, just about all broad market averages are in chop mode, and growth stocks are out of favor right now. Value stocks are up, and plenty of stocks from defensive industry groups, which is what we're going to take a look at right now. This list right here, the ETF sectors list, here I've sorted about 44 ETFs by the percent gain over the 52-week high over the past 4 weeks. And what we have here on this list is very defensive in nature. We have construction, utilities, aerospace, home builders, real estate, insurance, consumer staples, clean energy. That's the solar, I believe, that's running that ETF up. Then we have retail, but this is very big cap retail. And SMH is something we've been watching here. Hopefully the price action can hold above the 50-day MA over the next few weeks. If SMH starts to break down, possibly even below this uptrend line here, that could turn ugly. Just wanted to mention also the biotechs are taking a beating the past few days. And here's XBI losing a big support level so far at around 80. There was a false breakdown in early September and a rally into the 50 that stalled and some more selling. So biotechs are in a bit of trouble here. IBB also down to range lows. In terms of potential setups, what's on our buy watch list? We have very few stocks on the list. We'll run through a few here that are showing an incredible amount of relative strength. First up is SCDG. Failed a recent breakout attempt, but not a big deal there, as just about every stock that's not in a defensive industry group has failed recent breakout. And so far it's held up. And the past 2 days have been on very light volume, so that's impressive. So a pretty good looking chart here. Twitter still holding on to the 50-day moving average, and you can see on the weekly chart, the recent dip reversed just shy of the uptrend line here. So if Twitter can continue to chop around and remain above this uptrend line, and that eventually work its way higher, that would be a positive sign. And we have DOCU, which really isn't buyable right now. But if it can chop around up here for the next few weeks and touch the 20-day EMA, could be in play down the road. And of course there's Snap, which we were long earlier in the week. We sold with the small gain due to this ugly reversal here. But overall, I'd say it's held up the past 2 days. So we'll have to see how the action plays out the next week or two. If when market conditions begin to improve, it's possible that we might look to re-enter Snap. And I wanted to go into a bit more detail as to why we like Snap, and it's because there's a setup developing on multiple time frames here. If just looking at the daily chart, all we see is maybe the past 8 to 12 months of price action, just a strong uptrend. On the weekly, you may have a few years of price action. There's still a strong uptrend. It's not until we zoom out to the monthly where we see that Snap recently broke a downtrend line, and now it's consolidating in a tight range above that downtrend line, which is a really bullish sign. So there's something else going on besides the bullish daily and weekly chart, which is what we'd like to see on setups as much as possible. And we can also take a look at Twitter, which has a bit of the same type of feel here, with a clear break of the downtrend line. And it's an IPO recovery type play, which we call any IPO that debuts, maybe goes up for a few months and then just tanks for about a year or so. And here with Twitter, it broke down in 2015 and sold off through 2016 and bottomed out in 2017. So here's the break of the downtrend line and a new uptrend is established. And this is the first major base forming following that downtrend line break. So we think it has a ton of potential eventually when market conditions improve. Well, that's a wrap for tonight's video. Thank you for joining us, and we'll see you again next week. Have a great weekend.